Okay, this is for Accounting 113, Accounting for Entrepreneurs. This is almost the end of the class. Believe it or not, this is a gift. Learning about taxes, it's very hard, but I figure it's a gift to you. It's something that I think you'll use the rest of your life. There's almost no one that can't benefit from knowing about the tax laws in this country. I say almost no one. There's people that live off the grid, and they would not benefit. They would not care, and they would say, I'm never going to pay taxes. I've met those people, and they're very happy without tax law knowledge. Anyway, the book that we're going to be using is probably one of the best books in the United States, if not the world. It's Southwestern's Federal Taxation. I promise you, I know this says individual, but I promise you, you're going to be learning a lot more than just individual taxation. A lot of the things we get into deal with businesses. By the way, you realize, and you probably don't realize, but when you do your 1040, which is an individual income tax statement, it's a Schedule C, and a Schedule C goes into the individual income tax statement. And the Schedule C is for small businesses, along with a Schedule S, if it's a small business that's a Subchapter S corporation. So you see, this is a very good place to start. Again, we have to start here to learn a little bit about individual income taxation, because small businesses complete their tax returns, sole proprietorships and Subchapter S's, and they flow through. Oh, and partnerships too. If you're a small business partnership, that income will flow through the individual income tax statement. So again, and by the way, we will learn a lot of concepts that are applicable for both individuals and businesses. Gains, losses, capital gains, depreciation, basis, all those things are for individual taxation, and they're utilized in business too. Anyway, I'm going to switch over right now just to start and talk a little bit about how federal income taxation works in this country. And federal taxation in this country, let me see if I can roll that up a little bit. In this country, we have a progressive tax system for federal. By the way, there are many taxes. We're talking about federal income tax. This is a huge area, and it's one of the biggest taxes you pay. But state income taxes, we're not going to address in this class. We're not going to address property taxes. We're not going to address local income taxes. Sometimes there can actually be small income taxes based in a local area, a town or a county. We're not going to address things like sales taxes or any of the other taxes, excise taxes, sales taxes. None of those are going to be addressed. But the biggest, hardest taxes to do in this country, I think, are federal income taxes. And all of you will pay federal income taxes. Even if you don't pay federal income taxes, you want to file a return. Why would you file a return if you don't have to pay? To get your withholding back. Even if you don't owe taxes, you want to get the taxes that you've paid in, the withholding back. Let me say a couple things in general about this country. The way it works, and the way it works for you guys, is you fill out a W-4 when you get a job at an employer. It's called a W-4. And on the W-4, you tell them a little bit about yourself, how many children you have, if you're single, if you're married, filing jointly. You tell them a little bit about yourself, and then your employer uses that to withhold your taxes. And they withhold your taxes way before they're ever due. In fact, let me diagram that for you. Here's a year. If you were to work the year of 2019, you're going to work the whole year, and then you're not going to pay taxes until April 15th of 2020. So you see, all the withholding, I'm going to draw W's here. W's. Let me make sure too that you guys can see that. I may be off my screen. Yeah, just a little bit. You see, if this is the year 2019, you're going to work this year, and you'll fill out a W-4, and you'll fill out a W-4 right here where you get the job. When you get your job, you'll fill out a W-4. And the W-4 will just to simply tell your employer a little bit about yourself, and the employer's going to use what's the information on the W-4 to determine how much tax to withhold. And the truth is, you're giving the government their taxes before they're ever due. That's called withholding in this country. And you might say, that doesn't seem fair. But if Congress, and if this country didn't withhold your taxes, they would probably have to put half the people in this country in jail, because most people, if you waited till April 15th and said, pay all your taxes on April 15th, they'd say, I spent all my money, I don't have any. And then Congress would say, well, let's put all of you in jail. And nobody could support that, because we'd have to build so many new jails. So they don't do that. They say, you know what we're going to do? By the way, this is a concept. It's called the wherewithal to pay. In other words, when does a human being have the wherewithal to pay? Wherewithal to pay means you got money. That's when you attack. That's when the government attacks you. It says, they got money, they got a paycheck. Grab some of that money. So when you have the wherewithal to pay, the government steps in and says, we're going to take a little bit now, before you ever owe it. And in this case, you're going to, the W stand for withdrawals, not withdrawals, withholding. Sorry, they're going to withhold money from your paycheck as you work during the year. But really, they're guessing. That's a big guess. They guess at how much you owe. And then on April 15th, when you fill out your tax return, they look at how much was withheld, and this really is the accurate. This really does say, this is how much tax I owe. And they compare this to all the withholding, and they see how much you have to pay in more, or you might get a refund. That's how it works in this country. There's actually, you pay in advance for your taxes. And then when they're due on April 15th, that's when you settle up. That's when you really say, all right, let's find out, did I pay too much in withholding, or do I get some back? That's the premise of taxation in this country. Now, the tax laws are so onerous, so complex. They're literally confounding. There's just thousands and thousands of pages, and you might say that's crazy. But remember, Congress has had a couple hundred years to pass the tax laws. By the way, Congress is the one who passes tax laws, and the president signs them into law, and the IRS is responsible for collecting and enforcing those. But what was I going to say? The tax laws are so complex because Congress has two things. One, they've had 200 years to develop them. And two, they're trying to be fair. And three, there's politics and social values mixed in. So when you think, I've got to be fair, and what is there, about 300 million people in the United States? I think there's 320 million people. Think about Congress trying to write tax laws that are fair for 330 different million individuals in this country. Not all of them pay taxes, some of them are children. But certainly there's probably about 200 million that do. Anyway, that's very hard to write fair tax laws. And it's also, they write tax laws that are political, that reflect their political views. They also write tax laws that try and do what? Pay for the federal government, for roads and bridges and defense, and the park system. Anyway, this is the way they've decided to do it. They collect the money in advance with what? Withholding, and then on April 15th, 4 months, almost 4 months after you've paid in, they step back and say, fill out your tax return, let's see if what you paid was correct. This is the right amount, this was a guess. The W-4 is what you get at the beginning. You give it to your employer to have them guess at how much withholding. Then you get a W-2 at the end of the year that tells you how much wages you actually made. And the W-2 is used also on the tax return. Again, at the end of the year, they use the W-2 on the tax return. That's all your wages and all the withholding for state and federal. And also Social Security and Medicare. Those are in there too. All right, another thing. In this country, they have tried to be fair. What I mean by that is they have different categories of who pays taxes. One of the categories is if you're single. Well, most of you college students are single. And that's, again, a whole separate set of rates. Let's say again, let's block this off. This is, again, if you are single. Let's use a different. What if you're a head of a household? Well, why would you need a different tax rate if you're a head of household? Because a head of household has got a harder life than a college student. This is a person who usually has a house, and they usually have to have a dependent, meaning not only are they themselves, their own person is a dependent, but, well, That's called a personal exemption. But anyway, not only are you a dependent on yourself to generate enough income for yourself, but that means they have a child or relative. And usually head of household rates are lower. In other words, compared to single, this is a lower set of rates because these people have, again, more hardship, and they usually don't have as high of income, or if they do have a high income, it's, again, not taxed as heavily because Congress, who's trying to be fair, says, I'm going to give them a little better rate because they are, again, supporting someone and having a household. Then there's another rate, and that is married filing jointly. Married filing jointly. And married filing jointly are very good rates. Actually, that's, again, for a couple, whether same sex or different sex. But anyway, any couple can file married filing jointly, and these are actually very favorable rates. That applies to many people in the United States. And then there's married filing separately. Married filing separately is really pretty much the same or very similar to, again, single. And actually there's a couple of other categories that we're going to get into. One is called qualifying widower, or they call it surviving, V-I-V-I, surviving spouse, or qualifying widower. Now, if you're a surviving spouse or a qualifying widower, these are the same thing. They use, you know how terminology is in the United States. They many times the same phrase means the same thing. In this case, this is for somebody whose their spouse has died. And if your spouse has died recently and you're a qualifying widower, you will get to use, again, the married filing jointly. These are more favorable rates. Do you see if your spouse dies, you're single, but single are actually very high rates. So again, you want to avoid those if you can. But if you've died and you've got a child or a dependent, you can qualify for surviving spouse, and then you'll get to use the married filing jointly rates. Using married filing separately is just as bad as the single. And let me number these. Let me go from best to worst. Okay, this is the best rates. And when I say best, I mean lowest. Okay. Head of household is second best. Second best. Or I should say second lowest. And the worst, or let's just call it the worst, the highest rates and the worst is single. And by the way, these are the same. Again, single and married filing separately, they're the same. So anyway, that's another category. So you can be single, married, head of household, or surviving spouse. I was trying to think, is there any others in there? Surviving spouse, qualifying widower, head of household, single, married, filing joint. I think that covers them all. That's 1, 2, 3, 4, 5. Yes, that's 5 categories. Now also, one thing that you should know about the taxes in this country, they're progressive. What that means is the more money you make, again, the worse the rates get. Now, I'm not saying progressive percentage-wise. You might say, you know what I think he means? If you make $100 and you pay 10%, that's $10. But if you make $1,000, then you'll pay, and you pay 10%, well, that's $100. That's progressive. No, that isn't progressive. That's proportional. You'd love to have a proportional tax, but that's not what we have. We have progressive is more aggressive than that. It's steeper. What it means is, if you make $100 in this country, you might pay a 10% tax on that and pay $100. Whoops, $1,000. You make $1,000 and you pay a 10% tax, that's $100. But if you make $10,000 in this country, you'll pay 20% on that as it goes up. And that'll be what? You'd say, well, gee, if this is, again, if it's proportional, on $10,000, I should pay $1,000. But you're not, because it's progressive. Progressive means not only are you going to pay more because it's a bigger number, your rate is going to go up. That's progressive. And in this case, we're going to have what? $2,000, isn't it? Yeah, $2,000. Where again, 10,000 at 10% would be 1,000. But 10,000 at 20%, this is progressive. And let's say you make $100,000. Well, not only will you pay the 10 or the 20, you might pay 35% on that. So 35 of that, you're going to pay $35,000 in taxes. My point is, this means progressive. It's not proportional. Proportional means you pay the same percent every day. This is progressive. Now take a look at the progression. Again, or let's take a look at a single person. The single person starts out with, do you notice, a 10% rate. From 0 to $9,525, you'll pay 10%. Now, if you make $9,525 to $38,000, you're going to pay 12% on anything above $9,500. Do you see? Any money, once you get to $9,526, on that one next dollar, you're going to pay 12%. What if you get above $38,700? If you get it above the $38,700 or $1, on that next $1, you're going to pay 22%. Do you see? This is what we mean by great. I don't think I was talking for 15 minutes, but maybe I was. Let me check my... If you make above $82,500, like let's say you make $82,501, on that next dollar you're going to pay 24%. Do you see the progressiveness of the rates? The rates progress up to 37%. These are the worst. If you go to joint, let's just take a quick look, not married filing jointly. Well, look, you can make from 0 to 19. You can make a lot more and be taxed at 10%. You make from 19 to 77, and you're only taxed at 12%. Whereas up here, you already go to the, you actually are 22%. You see, you can go up to 77,000 and just be taxed at 12%. But if you're at 77,000, you'll be at 22% in this bracket. So again, single is the worst, the highest rates. Married filing jointly are the best. The second best are, again, head of household. And do you remember, surviving spouse and qualifying widower are going to get the rates on married, joint. This is very, you see, again, Congress is trying to be fair. Congress says, oh, if your husband just died, I'll let you be a surviving spouse or qualifying widower. They usually let you do that for 3 years, the year of the death, and the year of the death, and 2 more years after death. But you do have to have a child. That's one of the, you have to have a household and a child. If you have a household and a child, you're a qualifying widower, and you can use the very favorable best rates. Also, if your husband or your wife has abandoned you, you could use the head of household rates. And again, Congress is trying to be nice there. The problem with Congress trying to be nice is that Congress makes thousands, probably even by now it may be millions. I suspect it's not millions, it's tens of thousands, if not hundreds of thousands of tax laws to try and be fair to many different people in the United States. And it makes for an incredibly complex tax code. And as I said before, there's social motivations in there. Let me give you a social motivation for tax. Congress has taxes that are higher for people who smoke. If you go buy, now that's not federal, but if you go buy cigarettes or beer, well, Congress says, oh, those aren't good for you, so we'll tax those more heavily. Again, in our society, they're called sin taxes, and they tax you more heavily on things that are bad for you, like cigarettes and beer, and they tax you lightly for things like groceries. But there's social implications in taxes. There's political implications. There's political motivations. But the biggest motivation, I think, for Congress, to be fair to Congress, is that they are motivated to try and be fair to this very diverse group of people in the United States, and that creates a lot of tax laws. And this is just going over, again, the different tax categories for different people and the rates. Now, just to scan down briefly, there's also something that every person gets in this country, and I'm going to erase that board. Called the standard deduction. And most people take a standard deduction. What I mean by that is that Congress wants to keep things simple, but they have failed miserably at doing that. And they know it. I don't think there's too many congressmen or women, and when I say that, I mean the House of Representatives and the Senate. There's a little bit of red still left up there, but to make things simple, Congress said, well, you don't have to check too much your tax laws at all. I'll tell you what we'll do. We'll give everybody a big deduction, and if they do that, it'll make their tax return simple. And it's called the standard deduction. And again, all this is in your chapter 3. I think this is page 1 or 2 or 3, I don't know, it's the very beginning. And again, if you're single, they'll give you $12,200 of a deduction. Well, you know what this means? Let's say you make $9,000. If you make $9,000 and they're going to give you a deduction of $12,000, let's again just put that up here. You make $9,000 as a college student. Well, you'll get to deduct $12,000, and you'll say, well, hold it, I don't have to pay any taxes. You're absolutely right. Let's say you make $12,000. You still don't have to pay any taxes. They'll let you deduct that. Let's say you make $12,001. Well, you're going to have to pay taxes on $1. But you might say, well, you know what? Then I shouldn't send in a tax return because I don't make that much as a college student. Yes, you should. I think many of you'd say, I know I'm going to send in a tax return to get your withholding back. Do you see? You really will get most of your taxes back. If you're in this situation where you don't make a lot and you're a college student, the standard deduction means that you're going to get all your money back. Now, the government will take it on the premise that, again, you're going to owe them some taxes. But again, if you don't make it, if you don't make above 12, you'll get all your withholding back. All right? Now, there's more than one, as you can see. By the way, these change every year. This is for 2018. This is for 2019. And for a single person, you get 12. Look for a married person. In 2018, you got 24. Let's just focus actually on the 2019. 12.2 is a single individual. 24.4, double that for married filing jointly. Surviving spouse. Well, remember what I told you? She's a qualifying widower. I said she because most women outlive us. So again, I think that's a fair bit of sexism there. But a surviving spouse is usually a female. And again, they call that a qualifying widower. That's another name for it. But notice they get the same as married. That's really great, and that's Congress being nice. Head of household. Head of household is for somebody who, again, has usually got the male or the female, but the husband or wife are gone, and they have a child. Well, look, they get something better. You see, the best is married filing jointly. Second best is head of household. Third best is single. And again, married filing separately. I think my camera just kicked off again. Nope, it's fine. Married filing separately, look, it's the same as single, which would make sense. Now, there's a few things we've got to know, too. If you get really old, they'll give you a little bit more. It's called an additional standard deduction. And this is for people who are 65, either equal to 65. What do we say here? This is greater than or equal to 65. And also if they're blind. I know that's an odd thing, but if you're older than 65, they'll give you an extra standard deduction. Not only will you get, let's say you're old and you're single, you'll get the 12.2, but you get $1,650. That's going to be $13,850 together. You can add these two together. Now, if you're 65 older and blind, you get 2 standard deductions. So you get an extra one of these. But there's a lot of people that are over 65 and they'll get the $1,650. But there's not a lot of older people that are above 65 and get blind, so you're not going to run into that much in the tax code. But like I said, you can get 2 extra. Now, if you're married filing jointly, you'll get 13, and if your spouse was older, you'll get another 13, so you could get 2,600. If you're surviving spouse, the same thing. Head of household, 1,650. But these are, let's do head of household real quick. Head of household gets a standard deduction of 18,350. If you're head of household and you're over 65 or 65, you'll get 18,350. That's going to be 18. That's going to be 19. That's going to be 20,000 if you have those two up. If you have these two up, you'll get 20,000. So this is your standard deduction. By the way, if you make less, let's say again you're the head of a household and you're 65 or older, if you make less than 20,000, you won't owe any taxes because that's a standard deduction. You can deduct that. It hides income. Let's say again that you're old but you still work. And let's again say that you made $18,000. Well, you'll get again, if you're head of household, you won't have to pay any taxes because the 18 is less than the 18,350. So, but again, file your tax return because you get your withholding back. But you are legally not required to file a tax return if you do make less than your standard deduction. All right, let's go ahead and just try and see how progressive rates work. Let me erase the board for a second and I'll get right back on and show you how this progressive rate system works. Let me do an example for you. Let's just show you kind of how our system works. Let's again say that this is an example of a tax calculation. And again, you really won't get anything this easy on the test. But let's just start with something easy. Let's again say this is me. I get a salary at Illinois Wesleyan University of $85,000. I made some money on savings. I had some interest on some savings accounts. I had $4,000. Let's say my taxable income is $89,000. Well, again, let's go employed. Do you remember? Let's, by the way, say that I'm single and I have no children. Well, let's go back and find out. Do you remember what the standard deduction was? Let me scroll down and let's get it. It was actually 12.2, wasn't it? I scroll down there. Basic standard deduction, 12.2. So I can take that as a deduction. So I'll take STD, standard deduction, of $12,200. And again, that's going to be 800 and 876. And that's going to be 76,800. $76,800. And that is going to be, let's say, my taxable income. And this was really, I wish it have said this is my gross income. Let's just say that, gross income. This is my gross income. This is my taxable income after my standard deduction. You see, I am going to owe taxes on that. But let's calculate. Let's go back and let's calculate the taxes and see how this would work. Let's roll back to, again, the tax rate schedules. And let's look at this one. This is single. And let's do it, I'm going to do it a hard way. I haven't practiced this, but I think, okay, 0 to 9. All right, this is single. 0 to 9, 9.5 to 2.5 to 38.7, 38.7 to 82.5. That's where I'm at, right? I'm right here. Now, if you want to, there's an easier way to do this, but I want to show you the progressivity. All right, let's take 0 to 9.525. So 0 to 9.525. I'm just going to take a calculator and multiply that times 10%. So again, $9,525 times 0.1, and I should have known that is actually $952.50. So it's $952.50, and that's on the first 9,000. Now, I'm going to make, again, well over that. I'm going to make well over the 38.7. This is your second bracket. This is your first bracket. Your first bracket is a 10% bracket. Your second bracket is a 12% bracket. My third and final bracket, and by the way, this is when I'm in this bracket, that's my third final bracket, they call that my marginal rate. Again, that's the rate I'm in that, again, every dollar I make is going to be taxed at that at this point. You see, I'm between this. In fact, I'm right 76.8. I'm 76,800. Anyway, 9,525 to 38.7. I'm going to subtract that difference. And again, I'm going to take 38.7. Let's do it this way. 38,700 minus 9,525. And then I'm going to take that times 12%. That's my next bracket, or rate of tax. And again, this one, I should get 38,700 minus 9,525. That times 0.12. That is $3,501. All right, that's great. Now I've got the tax on this bracket. I've got the tax on this. $952 is my 10% rate. This tax is actually the 12% rate. Now, how much am I above? Again, 38.7. Well, in this case, I'm above 38.7, but I don't go all the way to 85.5. So I'm going to say, well, I know I'm making $76,800. That's what my taxable income is. minus, I've already paid taxes up to 38,700. But this time I'm going to take it times 22%, aren't I? Is that the next rate? Yeah, 22%. So, let me see, 76,800 minus 38,700, and then take that times 0.22, and that is equal to $8,382. Now this will be the amount of tax, but can you see the progressive nature of tax? This first lower increment of money that I made was taxed at 10%. The next increment I made from 9.5 to 38 was taxed at 12%. And from 38 to 76 was taxed at 22%. If I add these up, what do I get? 8382 plus 3501 plus 952.5. I get a $12,835.50. All right. That's the tax I owe. That is how a progressive rate system works. Now they have a shortcut here that's a little bit easier. You can actually just say, all right, let's take a look at the shortcut method. The shortcut method just says, all right, I know I'm in between here, so you can just take, again, $4,453.50 plus 22% of the amount that you are over. Do you see the way this works? It says, okay, how much are you over this amount? Multiply it by 22%. Well, again, and here's, let's even write it just this way. And let me swing it towards the other side. No, I'm going to leave it there. I'm just going to try and squeeze it at the bottom. I think I can. All right, like I said, I'm going to take $4,453 plus, again, the amount that I'm over. How much am I over 38.7? Well, I make 76,800 minus 38,700 and take that times 22% and then add it. Yeah. Take this, get that difference, multiply by 20% and add it. This is actually the tax. I should, if I add these two, get this 44.53. Let's just see if that works real quickly. Let me see. It should come out to be the same thing I got there, but let me see. I did 76.8 minus 38.7 times 22%. Should be 8.3. Same thing as here. 8.382. 8.382. Let's take that. 8.382 plus 4.453. 12,835. Okay, I get the same thing. This is equal to 12,835. Somehow I'm off by 50 cents, but I don't care. Anyway, 12,835, 12,835. You can do it the shortcut method. Again, just say, use they're saying you already owe, this is the tax on this previous income. Now, if you're over 38.7, add the amount your taxable income is over 38.7, which is this increment right here. That's the way the tax rate schedules work. By the way, most people don't use tax rate schedules. They use a tax table. But we'll get into that later. A tax table is easier. You just look up your income, and it'll just tell you the amount of the tax. But let's take a break right here, and I'm going to change topics. Okay, remember I just gave you an example of, I used myself as an example on how to pay taxes. But there really is a tax formula in this country, and let me show you how it goes. In other words, this is how you how you calculate your taxes. Remember in my example, income broadly defined, I said I made $85,000, isn't that what I said? That's what they mean. They also mean put in there, my $4,000 of interest, and then less exclusions. Exclusions are things where I made money, but Congress will let me exclude it. Let me give you an example. Let's say my father dies. He's still alive, but if he dies someday, he's probably going to give me some life insurance. When you get life insurance, Congress has said, well, you can exclude that. So again, they're really saying you can go and take certain, let's say I'd gotten $1,000 of life insurance from my father if he dies someday. which I hope he doesn't. But if I did get that, I could exclude it. I could take the 1,000 back out and just say, take that back out. Those are exclusions. That gives you gross income. Now you get deductions for, that's an important word, for adjusted gross income. These are very powerful deductions because they come straight out of your income. And let me give you an example of some of these. An IRA, that's the Irish Republican Army. No, that's an individual retirement account. And if you put in $5,000 into a retirement account, you can go ahead and subtract that. Student interest. If you have student interest on a loan, you can deduct it. If you have a capital loss, let's see, capital loss, you can deduct some of that. Let me see, I jotted down some other things. Let me see. If you have a health savings account, you can also deduct that. But these are again passed by Congress, and there are specific areas where Congress says, we'll let you deduct these. If you put some money in a retirement account, you can deduct it. If you have student loan interest, by the way, that's student loan interest, we'll let you deduct up to $2,500 on that. If you have a capital loss, we'll let you deduct up to $3,000 on that. All of these are passed by Congress, and they say, we'll let you deduct these for. That means they straight out come right out of your taxable income and reduce it. They're very powerful. This gives you a number that they call adjusted gross income. Adjusted gross income is super important because Congress loves to use that number to base other tax laws on. In other words, they'll use your adjusted gross income to determine how much you can deduct, if you're going to get a deduction, if you're going to get certain tax rates. Anyway, this is a very important number that Congress uses a lot for. Now, at this point, do you remember over here on my example, I said I get to take out my standard deduction. Do you remember my standard deduction for me was $12,200. If I was over 65, I could get $1,650 more. But I'm not over 65, thank God. Anyway, I get 12,200. But notice again here, they say something that's unique to you. They say, well, you get the greater of itemized deductions. Well, what are itemized deductions? You haven't learned that yet. But we'll go back and find out that Congress has set up a whole bunch of deductions that you can take and itemize. Itemize means that if you want to, instead of, see how simple this is? You can either use the standard deduction, which is simple, or you can go to the more complex itemized deductions. And let me give you a couple of what those are. The big ones would be interest on a house, loan, that's one, or property taxes, or your state income taxes. If you have medical bills that you are not covered by insurance, those can be deductible. If you have a casualty loss. Casualty loss means that a tree fell on your house or a tornado blew you away. This would be for Dorothy. All of these can be itemized deductions. Interest, again, your mortgage interest. Property taxes, state income taxes, medical bills. Again, these are medical bills that were not paid by your insurance. They're medical bills that you had to pay out of your own pocket. Casualty losses, where again it was uninsured. You truly lost the money. A tree smashed your house and you don't have insurance. All these things are itemized deductions. You can deduct those and then you can compare them with a standard deduction. And if these are more than the 12,200, you take them. But in my case, I don't think they are anymore. Again, the interest on my house, I've got it paid off. Property taxes, they're about $4 or $5 grand a year, I think. State income taxes, I don't even remember what those are. I don't have that bad of medical bills yet. I haven't had any trees smash my house, so I'll probably just take the 12,200. Now, then they say less personal and dependency exemptions. Well, that isn't true because Trump and the Republicans again changed that this year, or really last year, so that's gone, but it'll come back. I think they say it comes back in 2025. That's called, I think it's called a sunset provision. A sunset provision just means that when the sun sets in 2025 guess what comes back? Well, when the sun sets, when the morning comes, after the sun sets, the morning comes, and when the morning comes, this will pop back up and be the tax login. But right now, you don't get personal dependency exemptions, at least for another, 5 years. You do get a deduction for qualified business income. That's not going to apply to most of you, but it's usually, I think it's 20%. 20%. If you have a small business and you make $100,000, you can take $100,000 times 20%, that's a $20,000 deduction. So there's some limitations on that, but that's just to do simple math. Then you get taxable income. Then you have the tax on the income. Remember how you're going to do that? You're going to get those progressive tax rates and apply it. And then there's something that they call tax credits. The ones that you guys are going to be most eligible for are your kids. You get a tax credit for every child. I think it's $2,000, is that right? You get a $2,000 tax credit. Tax credit means, once again, how much taxes did I owe? I can't remember. I wish I would have erased it. I think I owed $12,000 though, didn't I? Let's just go out here and say I owed $12,000 in taxes. Well, if I get a $2,000 tax credit, I got a daughter and I have a son. And again, let's say my dad lives with me. I can get a $500 because he's a relative. These are all tax credits. That means, again, if I owe $12,000 in taxes, I can subtract $4,500, and that's going to be $7,500 I pay in taxes. So these are all tax credits. There's many, many tax credits, but the most common are for dependents, children and relatives, and then there's another one called the Earned Income Credit. That's a very common one. And then there's numerous other credits. I've gotten a credit for energy. I've bought, what I mean is there's tax credits for if you go out and buy a furnace, or if you go out and buy water heater that's extremely efficient. Congress will say, well, for doing that, we'll give you a tax credit if you make your house more energy efficient, so we're not as dependent. I believe years ago I bought a car, and they had a tax credit if you bought a good high mileage car. I can't remember what the name of that one was called. I think they call it something for junkers. It was a tax credit for, because you had to trade in your old junker. Anyway, this is called the tax formula. And one of the things we're going to talk about next is we're going to talk a little bit about these exclusions, and we're going to talk about income, what is taxable, what's an exclusion, and we're going to talk about deductions. All of these we're going to hit, and then we're going to try and do some problems. Let me pause for a second, and then I'll show you what some of these. Let's go to what income is, exclusions, deductions. We'll talk about, again, what are itemized deductions, and we'll talk a little bit more about tax credits. One thing I did want to mention, when you fill out your tax return, the vast majority of Americans use just a simple 1040 form. In fact, that's the standard form now, 1040. It used to be they had a 1040 EZ, and they had several other forms that you could use, but now they just, a form 1040 is what you use. There's 1120 is for a corporation, 1065 is for a partnership, but there's many different tax forms, but this is the number of the most common tax form. And then I do want to go over, remember I said we were going to go over a little bit what was in gross income. Well, let's just take a look. This is a list of things that go into gross income. Now, really, you'd be shocked, but just about every penny that you ever make is taxable. And let's say you have a garage sale. Well, let's say your next door neighbor comes over and says, hey, take this old lawnmower and sell it for me and you can have the money. And he gives it to you. He gives you the lawnmower and just says, sell it and you can keep the money. And so you sell it for $25. Well, your basis, that means what you paid for the lawnmower, was $0. So again, if you sell it for $25, that's a taxable gain. So yes, that's taxable. If you happen to get lucky and sell your bicycle to somebody, let's say you bought an old bike, or let's say you found a bicycle in the trash and you fixed it up, and you sell for $100. Well, you didn't pay anything for it, you got out of the trash, so it's a taxable gain of $100. Anyway, alimony. Alimony is not taxable now. I know this says a list of gross income items. It was taxable, but when Trump got done with this, this is no longer taxable. I guess that's because he pays so much alimony. Anyway, what is taxable? Annuities. Annuities are when you get those from a bank. How about an award? You win a safety award at work, it's taxable. Back pay, bargain purchase. How about a bonus? You get a bonus from your employer. Business income, that makes sense. Clergy fees, commissions, compensation for any service. You decide you're going to go rake some leaves, and you get paid $1,000 for raking a huge area of leaves, you got to pay taxes on that. Death benefits, that's again if life insurance and also death benefits from your employer. That is not life insurance. I mean, that's when your employer, you die, and your employer gives your wife something because you've died. Those are death benefits. It's not life insurance, sorry. If somebody owes you $100, if you owe somebody $100 and they forgive that, that's income. Dividends. Dividends are income. If you get dividends on stock. If you embezzle, if you steal money, if you find a wallet on the ground, all of those. If you find a wallet on the ground that has money in it, if you find a wallet in the creek, you're going to pay taxes on any money. Employee awards. If you get an award for safety again. Farm income, that would make sense. If you're a farmer, you have to pay taxes. Hobby income. You start a hobby, and again, let's say you're helping your friends fix up their motorcycles, and it turns out that your hobby actually starts making money, or maybe you raise miniature horses. Everyone would want to raise miniature horses, and even full-size ones once you graduate to that. But anyway, hobby income, miniature horses, whatever. You'll pay on the interest. Jury duty. Who wants to do jury duty? Mileage allowance for a car in certain cases, military pay, prizes, professional fees, rents, royalties, salaries, severance pay if you get paid by. In other words, you can see that most things are taxable. In fact, Congress really says, this is the way Congress thinks about your money. Everything is taxable. Everything is taxable until we being Congress, say it's not. And if you can't find somewhere in the tax code where it's not taxable, then you will include that in gross income, and it will be taxable. That's their perspective. Okay, these are itemized deductions. Now remember, many people, the majority of people don't take their itemized deductions. The majority of people take the standard deduction. Remember, I told you my standard deduction if I'm single, I'm really married, you know, if you're married, you get, what is that, 24/4. But I just try to make it simple, so let's pretend I'm single. 12/2, what could I itemize? Now remember, you're only going to take your itemized if you get more than your standard. Well, medical expenses. Now do remember, these are not just standard medical expenses. Those are medical expenses that you don't get reimbursed for. Most people like you will have health care. And if you have health care, it'll get paid for. But if you, let's say you have $1 million operation, and that 900,000 of the million is paid for by your insurance, but 100,000 isn't. And that's what it is. Medical expenses that are not reimbursed. State and local income taxes. Remember I said that? State and local income taxes. Real estate taxes. That's your property tax. I call those property taxes. Oh, there they are. Real estate taxes. Personal property taxes. Oh, real estate. I guess that's if you own some land. Interest on a home mortgage. I said that one earlier. Investment interest. Up to the amount of net investment income. So you can deduct investment interest if you're paid it. Charitable contributions. I believe you can deduct up to 50% of your AGI. There is a limit. Many of these there's limits on. Casualty and theft losses. Again, someone steals from you or your house gets destroyed in a fire. You can deduct this. These are itemized deductions. But many times, for most Americans, these will not add up to more than your standard deduction. And we'll talk about these more in detail as we go on. But these are itemized. Now let's back up a second and go back and address these are itemized. There's another, by the way, many times you'll see in a book, they call these deductions from. They call them from AGI. And these are kind of considered weak deductions. Just take my word for that right now. I'll tell you why they're considered weak deductions, because they have so many restrictions, and because most people will take the standard deduction. So again, you'll either take the standard deduction, and you'll see there's many restrictions on these. But these are from AGI, and they're only if you have more than your standard deduction. But let's back up a second and show you the deductions, not from, but for AGI. And for AGI, these are for, and they're very narrow, but these are very powerful too. These are for AGI. These are stronger deductions. They're more powerful. You get to take them and you deduct them before you ever get to adjusted gross income. They'll lower your adjusted gross income, which is usually a goal of most tax payers. You want to lower adjusted gross income. Trade or business expenses, that's on a Schedule C. I know you haven't seen that yet, but you will some, not unless you take more tax. But that's for business. If you have business expenses, you can deduct them. If you're a business and you have to pay self-employment taxes, you'll have to pay them twice. That's Social Security, you can deduct those. Here's your IRA. Remember I said the Irish Republican Army? Well, it's the Individual Retirement Act. Again, if you put up to, I think it's 6,000. Did I say 5,000 earlier? You can put 6,000 in there and deduct that. These are for, that's what they call them. These are much more powerful deductions, and you can take them straight off your 1040 tax return. Let's see what, there's a couple more. Same thing, contributions to, again, a health savings account. I believe the health savings account you can take up to 3,000. I can't remember on that. Maybe it was 3,500. But every year you can put 3,500. That's again for your health. If you want to use some of that money to again pay for, let's again say, things that aren't covered under your normal medical insurance. Like let's say you want LASIK surgery for your eyes. You can put that in your health savings account. Interest on student loans. You can deduct up to $2,500 of interest on student loans. Excess capital losses. You can deduct up to $3,000 on excess capital losses. Certain alimony payments. Usually you can deduct your alimony. That is a deductible expense because, again, you're paying it. Again, I think this kind of favors divorced people, but whatever. There's a lot of them. So anyway, certain alimony payments, you can deduct those, and I don't know what the limit is on those. But these are deductions for AGI, and they're much more powerful than deductions from. Usually deductions from, you never get to take them because, again, you'll take the standard. Now, with this in mind, let's go out and actually try and work some of the problems we've got. The problems we've got are warm-ups. The problems we've got are going to cover the same things I've just gone over. We're going to start with just saying, is this a taxable? Is this gross income? Is it not gross income? Is this going to be, what's the standard deduction? What kind of taxpayer are you? It's going to ask you, are you a head of household? Are you a qualifying widower? There's just going to be some warm-ups just to get us, we're not going to do any computations, at least not for a few problems. All right, the first problem we're going to work is exercise 1. It's a discussion question, and it is a warm-up, but it says, during the year, Addison, I don't know who Addison is, but Addison must be a human being, I'm assuming, is involved in the following transactions. What are the possible income tax ramifications of these transactions? I really don't know. I did this problem a while ago, and I can't remember what they are, the ramifications. All right, lost money gambling on a recent trip to a casino. Well, I would tell you that probably 80% of the people are not going to be able to deduct that, but the law is this. You can deduct losses, but only to the extent of your gambling gains. But that is a good deal because most people lose more than they gain. By the way, if you win money at a casino, they will fill out, I think it's called a Form 1099 gambling. You'll be taxed on that. So this is a good law, but you can only deduct them to the extent of gambling gains. But as I recall, that has to run through itemized, so that's another one that you won't get unless you itemize. Again, Addison helped pay for her neighbor's dental bills. The neighbor is a good friend who is unemployed. This is not deductible. No, you can't deduct that. If they were your own dental, you could, but you cannot deduct. But your, again, you can't deduct expenses if they're not for you. Again, that if anything, that would be a charitable contribution. No, it wouldn't be. It's just not deductible. You're not going to be able. That's not going to show up in your tax return. You're not going to be able to take that. Okay, received from the IRS a tax refund due to Addison's overpayment of last year's federal income taxes. This has no tax implications. What we mean by that is this is income of some sort. It's not really income, but again, it's not taxable. It's not income. It's not taxable. It's not income. So again, no tax implications. It's not taxable. It's a refund. In other words, you paid it, now you got it back. You're no better off. You're the same as you were. You have not improved there's no income here. You have not improved your situation. All right, how about this? Paid a traffic ticket, received will double park. Can you deduct that? No deduction. You can't deduct fines. If you were to be able to deduct fines, that seems counterproductive. I mean, at least in a way, if you could deduct a fine, it means that the federal government is somewhat subsidizing your poor behavior. In other words, you say, oh, I got a ticket today, but luckily it's tax deductible. So it doesn't feel bad. You know, it doesn't feel as bad. No, they're not going to let you deduct things. If they let you deduct things, and again, it would be like the federal government saying, we encourage you to go out and do that. And they don't. Contributed to the mayor's re-election campaign. Let's just get to the heart of that. That's not deductible. You don't get to deduct contributions to any kind of politics. So no, not deductible. In other words, this is not going to show up in a tax. E will not show up in a tax return. D will not show up in a tax return. C will not show up in a tax return. B will not show up on a tax return. A might in fact show up on a tax return. Borrowed money from a bank to make a down payment. If you borrowed money from a bank, let's say you borrowed $1 million, but guess what? That is not taxable because it's not income. Do you see you're going to have to pay it back? Once again, that's not going to be on a tax return. That's not taxable income because you're going to have to do what? If you borrow $1 million, you got to pay $1 million back, and that means you're in the same fiscal position you were. You haven't changed. So there's no betterment. There's no improvement there. There's no, an economist, an accountant, and the government all agree. You haven't made money on a loan. Sold a houseboat and a camper on eBay. Both were personal use items. You used them for your fun. And the gain from one offset the loss from the other. Guess what? This is a bad deal. The gain, you're going to have to, you will again, the gain, let's see if I can get out of the way. The gain is income. The gain is income, and you'll have to pay tax on it. Guess what happens to the loss? The loss, the government just says, too bad. We're not going to let you. The loss on a personal item is not a deduction. Let me repeat that for you. You go out and sell your motorcycle for $500 more than you paid for it. Let's say you paid $1,000 and you sell it for $1,500. You're going to have $500 in taxes. Then let's say a few months later, you go out and sell your computer. Your computer, you paid $1,000 for it, and you could only sell it for $500. You've got a $500 loss. The government says that's a personal use item. They're both personal use items. But the government says this: if it's a personal use item, you can't deduct a loss. But if it's a personal use item and you sell it and you got a gain, you pay taxes on it. You don't like that. I don't like it. I don't think it's fair. But Congress says that's fair. And they passed the tax law and got it through Congress. So gain on personal use items are taxed. Loss is not. That will go on a tax return. You're going to have to pay. Paid for a dependent grandfather's funeral expenses. That's a personal issue. And again, this one will not go on a tax return. This is not deductible. I want to make sure my tape is still going. It shows me low in power. Paid premiums on her dependent son's life insurance policy. That's not going to go on a tax return. That is not deductible. Do you see a pattern here? Most these on a dependent son's life insurance policy. For a dependent grandfather's funeral, many times in your lives, personal expenses are not deductible. Personal expenses are not deductible. If you go out and buy food, shelter, if you go out and buy a car, boats, those aren't deductible. In fact, I'd say the vast majority of what you spend in any given week isn't deductible. What you spend in a given year isn't deductible. Most things aren't. But I will tell you, anytime you make money, making money means you made more than you originally paid. You buy a bicycle and you pay $50 for it at a garage sale. You fix it up and you get $1,000. You're going to have to pay taxes on $950. So, anyway, this is the answer to the first one. What are the possible income tax ramifications? There you have it. Now we're going to go on to exercise 2. All right, exercise 2. Still we're working on the last part of 113, which is income taxes. Which of the following items, again, this time says, again, are inclusions in gross income. Inclusions mean they're taxable. Which of these are included in gross income? All right, let's just go through them. During the year, stock that the taxpayer purchased as an investment doubled in value. Let's say he paid $100,000 for it, and now it's worth $200,000. Well, there's no tax on that because, again, it doubled in value, but he didn't sell it. In other words, this is, we'll say, which of these are in, this is, again, excluded. And I don't really want to call it excluded. I don't think that's the right word we want to use there. This is simply not realized. This is not a realized gain. You don't have any money. It may have doubled, but you didn't go out and sell it. Now, if you sold it, you'd have tax. But this is not a realized gain. This is, again, not taxable. What was the question here? Which of the following items are inclusions? Well, this is not an inclusion. It's not taxable. It's not an inclusion. All right, amount of an off-duty motorcycle police officer you received for escorting a funeral procession. That's an inclusion. That is taxable. That's going to go inclusion in gross income. While his mother was in the hospital, the taxpayer sold some of her jewelry to help pay for the hospital bills. Well, this one I don't know quite how to answer. If he sold the jewelry and kept the money for himself and basically stole it, then it's taxable because he got all the money and he had no basis in it. In other words, he didn't pay anything for it, so all of it's income. But I suspect, again, in this case, let's say again she had $10,000 worth of jewelry and he probably sold it for $6,000, that's a loss. So again, that's not going to be taxable. While his mother was in the hospital, the taxpayer sold some of her jewelry to help pay for the bill. If it is a gain, it would be taxable. So let's just put it this way. If he sells it for a loss, then it's not deductible. So you'd say it's not deductible. If he sells it for a gain, if gain, then it is an inclusion. So this one I don't really know how to answer because I don't know what they got out of it. But if again he sells the mother's jewelry at a loss, then it's not deductible. But if he sells it for a gain, then it is an inclusion. Child support payments received, those are again not an inclusion. It's not inclusion. Child support, again, Congress leaves that alone. Do you see why? Again, Congress is saying, let's just be nice. Let's not take and tax child support because it's for children. A damaged deposit the taxpayer recovered when vacating the apartment. Do you guys know, again, if you put $400 down and then the landlord will give you $400 back. Again, you give the landlord, and then when you move out, you get the $400. Do you see, again, you're not in a better situation? This is not income. So this is not an inclusion. This is not an inclusion. Interest received by the taxpayer on an investment and general purpose bonds by IBM. This one is an inclusion. This is income. When you get, interest, interest is making money. It's not your original investment. You're getting paid in addition. You're getting paid compensation. That's income on your investment. So again, this is an inclusion. Congress considers that to be money. It's more than you invested. Amounts received by the taxpayer, a baseball Hall of Famer for autographing sports equipment. Yes, this is an inclusion. That is an inclusion. Tips received by a bartender from patrons. That is an inclusion. Congress has had trouble for many years getting people to put their tips on their tax returns. So Congress has now changed the law where they force you to declare so much of your salary or so much of your income in tips. If you're a waiter or waitress or a bartender, you have to declare part of your wages in tips, even though you may claim that you never got any. Taxpayer sells his Super Bowl tickets 3 times what he paid for them. That is an inclusion. That's an inclusion. You're going to have to pay, let's again say he paid $100 for a ticket. Let's say he paid $400 and he sold them for $12. Well, that's a gain of what? He's got a gain of $800. That is what he's going to have to include in income, the $800 gain. Whoops, I drew that to the wrong one. It's I, taxpayer sells a super. Again, this is called basis, and this is called what you realize. What you realize is greater than the basis by 800. That's your taxable gain, Congress. Do you see that's an economic gain? Gain is, your excess of what you get for something, the increment above what you paid. And the basis, if you get back your basis, that's not gain. Taxpayer receives a new BMW from his grandmother when he passes the CPA exam. Well, again, you'd think that would be, but you're allowed to get a gift. Congress says you can get a gift. This is, again, not an inclusion. Not an inclusion. This is a gift. I can give my son or daughter a BMW when they graduate from college, and a gift is not taxable. It is not taxable to the recipient. And it could be taxable to me, but I have to give them a lot of money before it becomes taxable. I believe you have to give them, that's an estate tax where they do that, a gift tax, but you have to give a lot of money. It's in the millions before it becomes taxable. So that's one again that we got. Not taxable, that's an inclusion, not deductible. So loss, not deductible, and then we can put a colon here. If gain, it is an inclusion. Child support payments received, no, not an inclusion. Damage deposit, not an inclusion. Interest is an inclusion. This is an inclusion. Inclusion, you guys are clear on that. That's taxable. That's gross income. You're going to put it on that tax return, and it's going to flow through the 1040 and be taxable. All right, let's go to the next problem. All right, this is exercise 3. And in exercise 3, again, we're just doing a warm-up, and it says, which of the following items are exclusions from gross income? Again, these are things that, again, we do not have to put on the 1040. These are the kind of income you desire because they're income, but you don't have to put them on your 1040. They're excluded. Excluded. So, alimony payments received, those relates to a divorce in 2016. Oh gosh, that changes everything. If in 2016, these are taxable. These are, again, this is, we'll call this, which of these are exclusions? This is an inclusion. It's taxable. Be careful on this one. If they had said 2018 to, I think, 2025, you see why these tax laws are so crazy, because they change them all the time. But if the divorce occurs between 2018 and 2025, then guess what? It is an exclusion. It would be an exclusion. Let me do that in a different color. We'll do exclusions in red. So if it's a divorce from 2018 to 2025, that's a Trump tax law. He doesn't want those, for some reason, he doesn't want those, the alimony payments to be taxable. Like I said, maybe that's because he's got a lot of wives. Inclusion, again, before the Trump tax law, it's 2016, those again were non-taxable. Alimony payments were again, oh, hold it, what did I just say? Yeah, they're taxable. In 2016, 2017, yeah, all the way up to 2017, they're taxable. But now they're not, they're excluded. Damages awarded received by the taxpayer for personal, damages awarded received by the taxpayer for personal physical injury. Let's again say I'm mowing my lawn and I hack my leg off with a lawnmower and it's because the blade is faulty. And then I gotta pick up my leg and take it to the hospital and they sew it on, but it's still very gimpy. So again, I get $1 million from, again, the mower company. And the mower company gives them $1 million, is that taxable? No. No, it's not. Whoops. Yeah, it's not because it was, do you see again, Congress said, well, you know, when you're damaged and you get money, I don't think we'll tax that because it's really just making you whole again. It's really making you, it's trying to get you equity, just back to where you were. It's supposed to be, again, our parity. Let's get you back to where you were. Is the million as good as a leg? No. But Congress says, let's not tax that because, again, that's just for damages. So this is, let me see, which items are exclusions? This we will put an exclusion as taxable. This is an exclusion. You're not going to put that on your tax return. A new golf cart won in a church raffle. That is actually an inclusion. That's taxable. Yeah, you won that golf cart. Hey, if you don't put that on your tax return, you know what you are? You're sacrilegious because you got it at a church raffle. You got to put that on there. You're sacrilegious. Okay. Amount collected on a loan previously made to a college friend. So you loan a college friend $1,000 and he gives it back to you $1,000. Well, you're no better off. That's not income. So you don't have to put that on your tax return. So we would say that this is an exclusion. It's an exclusion because it's not income. Yeah, you don't have to put that on your tax return. Insurance proceeds paid to the taxpayer on the death of an uncle. She was the designated beneficiary. That's an exclusion. Let me explain that. You don't have to put that on your tax return. Congress again said, you know what? Let's not tax death. At least not when someone dies and you get a settlement, life insurance. Let's not do that. Let's not tax, again, the proceeds of life insurance. And it's, again, Congress just saying, let that money flow to, again, the heirs, and let them have that money and let's not tax it. So, again, this is Congress being polite and nice, and they're saying, we won't tax insurance proceeds when someone dies. Interest income on the City of Chicago bonds. Those are excluded. And I'll tell you why. These are, again, municipal bonds. These are not taxable. Usually, any type of municipality. A municipality is a town, a township, a governmental unit. Again, there's an agreement that usually governments don't tax governments. In other words, the federal government isn't going to tax income from a state government. So there's this agreement between governments. So in this case, if the City of Chicago pays interest, the federal government says, all right, we will not tax that. We'll leave that alone so that the City of Chicago can sell bonds easier. Jury duty fees. Oh yeah, those are taxable. Jury fee. This is, again, not an exclusion, that's an inclusion. Inclusion means it's taxable. Inclusion means it's taxable. All right. Stolen funds the taxpayer collected from a local food bank drive. So I volunteer at a local food bank drive and I get some money and I steal it. It's supposed to go to, again, poor people, but I steal it. Well, guess what that is? That's taxable. I know you're saying, well, who would declare that? But it's still taxable. This is an inclusion. And you're going to have to pay taxable. That's taxable in that. Reward paid by the IRS for information provided that led to the conviction of a taxpayer for tax evasion. That's an inclusion. You're going to have to pay taxes on that. An envelope containing $8,000 found in a creek. It doesn't say that. It said, found by the taxpayer in a bus station. Well, guess what? That's what we call a treasure trove. If you find a treasure trove, you got to pay taxes on a treasure trove. Yeah, that's an inclusion. That's an inclusion, it's taxable. Many people probably won't put that on their tax return, but if they don't, they have violated the tax law. They, again, can be fined or imprisoned, although most of the time they don't imprison you, they want the money. Most of the time Congress wants the money more than they want you in jail. Let me see here, we got them all. Let's mark off the ones that, again, would have again, which ones would go on a tax return? Alimony payments received, again, those are now, in 2016, those are taxable. That would go on a tax return. Damages awarded by that one doesn't go on a tax return. A new golf cart, that's on a tax return. This one, collected alone, that's not on a tax return, it'll be excluded. That'll be excluded off the tax return. That'll be excluded off the tax return. You might have to actually put it on the tax return, but that's not getting that. Jury duty fees, that's on a tax return. Stolen, that's on a tax return. All these, yeah. But these, when they say they're excluded, it really means, hey, you're really not going to pay taxes on those, and you might not even have to put them on the tax return. In some cases, the government makes you put them on some form, but it's still, even if you report it, you still won't pay taxes on it. All right, let's go down to work number 5. I think number 5 is a little bit harder, actually.